All right. I wanted to do a kind of a quick video on, the last couple weeks. Of course, the last time that I uploaded anything was after the trade I made off the CPI data in anticipation that it was going to be bad. And that trade worked out very well. There was a couple things that I didn't like about it, which I don't actually remember if I stated, but I didn't get up to the full size of the position that I wanted, even though I had really high confidence in it. So I kind of look at that as a failure because with the level of conviction that I had, there's no reason I shouldn't have gotten to my full size, potentially even a little extra, like if my full size, if I planned on having, 750 shares was my ideal spot. um, there's an argument to be made that since I was super confident and already had a profit cushion going into the report, that I should have been adding into, like, it jumped up on the report and I should have been adding right in there because we got 3 clean days of momentum on that triple leveraged inverse NASDAQ ETN. And I did not do those. So it was good. It was my most profitable trade I've had in several months, but at the same time, there was definitely room for improvement. This week is in stark contrast, unfortunately, to that trade. I haven't given back all of the profit from that, but sadly, I have given back almost half of the profit from that trade. Um, as it sits right now, I'm down on the week. Uh, Actually, I don't even know how much I'm down on the week. I'm down just today. I'm down about 500. That trade did actually yield a little over 4K. So it was pretty good. Like I was selling pieces into momentum. Uh, as I said before, I didn't get up to that full size of 750 because I was like, oh, should I move my cost basis up? I don't really know. But like in hindsight, it's like, yeah, dumbass, you already have a big profit cushion. Um, the My conviction was that the real move would be the after the CPI data, the day of, because it actually, the data comes out pre-market, so I should have been buying the day of, and then that momentum continued for a couple days, which is what I expected, but I didn't do that. Um, but yeah, overall, I've given back not half, but close to half, like 30, somewhere around between a third and half of what I made on that trade just in the last few, um, about a week approximately. And the reasoning for that was just sheer impatience, sheer lack of keeping the bigger picture in mind. Like that trade did so well that I don't know if it was like a little bit of hubris or if it was just like the level of conviction that I had. And I've been listening to a ton of macro um, analysts lately, and they're all so incredibly bearish that like I need to understand that. Like if I take in 3 hours straight of different, podcasts or whatever of macro analysts taking bearish, I need to kind of think like, okay, let me zoom out a little here because I'm looking to trade. I'm not looking to be positioned for the next like 6 months to a year. I'm looking to be positioned for the next like 6 hours to a day or a few days, and I let that get away from me, specifically on what was it, Thursday. um I went short again and I held the position because we got the overnight move. As you can see, it's kind of behind me. Oh, I guess it shows it right here too. This day we ran up and then got this move overnight. So this day I actually got short again, but I held it, because I had some profit on it, but I held it thinking, oh no, we're going to move lower. This momentum's going to keep going. Well, then I finally, licked my wounds and covered here. And then once again, this day we pop up here a little bit. I got short again, got chopped up, and then once again I wasn't executing on the Nasdaq. I was actually executing on the SQQQ leverage fund. Um, and anyways, I got fairly chopped up, and the reason that I'm kind of saying this is because what gave me, like, brought me back to, knowing that I need to zoom out and be a little less bearish and a little more objective, is that this episode actually of Chat with Traders that I got here, it like this guy right here, this part, I'm gonna play some of this. I might pause it and make a little bit of commentary, but for the most part, I think I'll just let it play out, because a couple things he says is really key, and I've added some indicators over here actually to reflect what he said. I'm gonna start trying to test it out, but I think, like you for me anyways, I get so focused on the market that it's like I'm looking at it this close, when sometimes you just need to take a few steps back, if that makes sense. And it's like I'm only seeing what's right here and I'm thinking about that, but I'm really, my positions and my time horizon is a little bit further out. Um, and then I get so caught up in what I'm looking at that I'm not looking at the big picture, which is what happened to me this week. And yeah, so I'm just going to play this out, and then I'll probably perseverate further about the issue.
Refers to time, which you try to remove, right?
Right, for sure. For sure. I mean, I don't live in a vacuum. I understand that other people are going to use this, and you're still looking for, essentially, we're trying to put together the pieces of the puzzle. And so a lot of that is, what does the market want to do, right? It's not about what I want to do. I mean, think about it, right? We come to work, it's like we have to dance with who brought us.
Mm-hmm.
We have to trade what we see, not what we think. What does the market...
So that right there kind of slapped me in the face too. It's like, once again, listening to those macro analysts and also having such a pessimistic economic outlook of my own, it really just made me realize, like, when he said that right there, like, you got to trade what you see, not what you think, I was like, exactly what I've done when I've been getting chopped up this week is not even paying attention to what I was seeing. I was simply acting on what I think. And that's well, my P&L for the week shows it. If that says everything you need to say.
Market want to do. So we have to be able to look at what everybody else is looking at, and then we have to be able to see if we can't see the flaw in their logic using conventional methods. If we can't see the flaw in their logic, then we have no reason to fight them, right? The only time that we can fade the obvious is when we see the flaw in their logic. And so that comes from thinking originally and trading is not a neat and all tied up in a bow experience. It's really messy. Like, essentially, what does trading teach us? Right? It teaches us that life is messy. It teaches us that we need grit. It teaches us that we need to come back from negative experiences. So it helps to understand through, in my case, I'm using a flow chart, a trade flow chart on CQG, a 1-minute chart with a reversion to the mean program. Everybody should build that, right? 80% of the time the market's reverting. So in your toolkit, you should have a reversion to the mean program. Then in my 30-minute, I use a 30-minute bar chart with a 65 period and a 33 period moving averages. And
so before, when I said I added some of the tools that he speaks about, that's this chart right here. Like, the yellow you see is actually something he didn't mention. It's Bollinger Bands. I've never used them. I was just going to see what they looked like. But actually I also have what he mentioned there, but I only have what he mentioned there up here on this chart. He mentioned a 30-minute chart with a 33 and 65 period moving average. So I put both of those on, and then I always have the 2-day, week, and monthly volume weighted average prices on my charts. I just kind of like to know where they are. And as you can see multiple times, which this will hold true to something he's going to say here momentarily, is that 80% of the time the market is reverting to its mean. You know, it's like we get extended to the downside, and then here's the monthly volume weighted average price. We're about 7% away from it right there. And then we come up and we get to it and actually coast above it for a little bit. And then the market is fairly balanced in this region. And then we have a vertical move away. And, you know, like I said, I get too close to my playbook. Oh, what play is this? What play is that? That I forget to actually look at what category of play it is. Like, you have the two main categories of trades that every single trade falls into. It's either a mean reversion trade or it's a breakout. And then within those, there are subcategories of trades. But every single trade is one of those. And I wasn't thinking about that. I was just thinking about, you know, my own bias. And yeah, once again, the P&L reflects it.
Then in my 30-minute toolkit, you should have a reversion to the mean program. Then in my 30-minute, I use a 30-minute bar chart with a 65 period and a 33 period moving averages. And when those lines go flat, everyone should build this too, a 30-minute chart with 65 and 33 period moving averages. When the lines go flat, that's
And I just wanted to quick say, I actually have this on my futures on my top monitor too. I put those same moving averages on the futures chart too. So 30-minute chart, and then the 33 and the 65 that he mentioned. Once again, the volume weighted average prices on there as well. But I'm trying to focus on what he's saying so that I can use those instead. You know, like what he's saying there, you know, you get underneath both of them for a bit, buy it, expect a reversion to the mean, and go from there. You know, maybe you buy a decent amount of your size here, a decent amount of your size here, and then you're selling pieces in the profit as you're going along. You know, it depends on your time horizon, your conviction, but nonetheless.
Let's go flat. Everyone should build this too. A 30-minute chart with 65 and 33 period moving averages. When the lines go flat, that's essentially a quick and dirty way to see if the market's balanced. And so we know from a balanced position the market has doesn't mean it has to, but it has the ability. Can keep going, be balanced forever, but it probably won't be. But it can go vertical. And then I keep a daily chart with the longer term moving averages, the 200 and the 21 day, just because I have the space for it.
I don't want to gloss over the point you made there about how, you know, did you say 80%? Either way, it was the bulk of your trading is reversion to the mean.
Oh, on the statistics, right? The breakouts only work, what did they say, 15% of the time, 12 to 20%, something like that. Around 15% breakouts are only successful 15% of the time. So if you're looking to do, you know, a successful job.
And that was the other thing that really hit me. You know, it's like which I guess is still just pretty much the same topic, is the reversion to the mean and the breakout. Like, everything is one of those two trades. Maybe it's a subcategory, like it's earnings, or it's just sector strength, or news, or, you know, like legislation. Like, there's reasons for the breakouts and such, but it's still within the category of breakout. And there's reasons for, like, the mean reversion, you know, like, oh, something's oversold and some of the shorts are taking profit. Other people might think, oh, this is a nice time to pick some up. So it's going to get, you know, it's going to drift back upwards towards the mean. But yeah, when he said that 80% of the time the market is reverting to the mean, that just that has to slap you in the face. You're like, well, fuck, you know, it's like, you don't know exactly how far it's going to go. So like myself, I like to pyramid into positions, because maybe my first little piece isn't exactly, you know, where it's going to bottom. And if I'm expecting it to go up towards the mean, then buy a little bit, buy a little bit, buy a little bit, and then at some point you should definitely, you like like the blue zones you see on this chart, like buy some in there, buy some in there. You're in here, watch how it acts. I draw those based on the volume profile, but nonetheless, you should always have that area where you're like, okay, if it breaks much below here, like I'm just out for now because maybe it's going to go quite a bit lower. Or you can do what I do and use like different hedging techniques, like I will execute on the QQQ, and then if it's working against me, like let's say I wanted to get long QQQ, I would and it's going against me, I would start buying SQQQ to hedge that out, and then as the Qs start coming up, I'll start buying more pieces of it to lower my cost basis on the QQQ. And then as long as it's still in my risk area, then I'm hedged with the leveraged ETN. And as it starts to look like my trade is working, I take the hedge off for either like pretty much break even or a small loss. But the thing is like the actual position will gain much more than the hedge loses, is the idea. And also, if you do get some sort of crazy news, you're in that hedge, then you can start piling into the hedge as opposed to piling into the initial play that didn't work.
Create a small positive cash flow over time. You need to be first a reversion trader.
Okay. So ultimately what that means is you're buying weakness, selling strength. What kind of signals do you look for? Like what would be a strong signal for you to actually take action and, do one of the above, either buy weakness or sell strength?
Let's just look back at where are the flaws in that strategy, just so it's like first do no harm, right? Understand when you're using a reversion to the mean program, the mean can change fast on a news event, right?
Yeah.
So we understand that it is a tool. It is not, and it happens to function 80% of the time. But again, it is not God. It can be wrong. And so with that in mind, the understanding is that you need to know where you are in the cycle of if the market's balanced. If the market's balanced, and you can do that by looking at the 30-minute chart with the 65 and 33 period moving averages on a 30-minute chart. If the lines are flat, then the market's balanced. If the market's balanced, the reversion chart is not the tool for the day, right? Because the market's going to go vertical and there's going to be no retracements, because the only person who knows how far it's going to go vertical is the person with the biggest order, and they're not telling you how big it is. Once the lines get separated on that chart, the market's had a vertical move. The reversion trades, tools that you're making, right? You're building bands around a moving average, a VWAP, whatever you may choose to use, is the tool. And so given that the breakouts only exist 10 to 15% of the time, that means that 80% of the time that reversion chart's going to work. But you just have to make sure that you don't get caught in a vertical move.
What are some ways to get caught less in vertical moves? Is this where your analysis with volume profile comes into play, or
yeah, right? Where
are there some other nuances to it?
Okay, so in a market profile, if you were looking at a market profile, we would define the balance point as the wide spot of the profile, right? The fattest part of that profile, a standard bell curve distribution smack dab in the middle, right? So when a market, or in the case of that 65 and 33 moving average on a 30-minute chart, when the lines go flat, it's not a crossover system. When the lines come together and the lines go flat, right, that's telling you that the market participants have decided this, for whatever reason, this is a fair price, right? And so our strategy is diametrically opposed. It's completely 180 degrees the opposite of a reversion the understanding is that when the market's balanced, it's going to go vertical from that balance point. Always does. Okay, any vertical move is coming from a balanced position, generally speaking. And so the way to trade that would be, you could literally, if you sense the market balance and starting to break out, you say it's going to break to the upside, and you're expecting a vertical move, not a reversion, a dislocation of inventory. You could
Autofilled.
literally buy one and wait 30 seconds, and if it's not in your favor, you get out. But you could literally write a program that would say buy one, and then 30 seconds later buy another automatically, and then buy another 30 seconds later, and then buy another. And then as soon as the next 30-second entry level is below your most recent entry, you just get a box that shows up and says, would you like to exit the trade? This entry is no longer at a higher or low, in the direction that you're trading, and just hit exit. And that would be the way you could trade and exit. No, as far as I know, no one has written that program, or they are doing it in the high frequency shops. But that would be the way that you would trade the market from a vertical, a balanced position, expecting it to go vertical. The same thing works to the downside, right? And then the reversion is 180 degrees the opposite, right? So now, after you've had the vertical move, this is where the art of trading comes in. How far is too far, right? Does prudence dictates exiting a winning position long before the high? Not every tree grows to the sky. Nobody, there happily ever, not everybody has happily ever after, right? The idea is how far is too far with vertical, and you start to trade, the market's going to.
So that was another one. I missed it. I was paying attention to, I put on just a tiny bit more of the hedge that I'm using right now against my QQQ short. As you can see, the NASDAQ's up today. I bought a decent amount of FNGU, which is the FANG up leveraged ETN. So as the FANG stocks move up, it moves up at 3 times the rate as measured by NYFANG. That's actually what you see right here on this chart. So I bought quite a bit of it. I bought a little bit before the open. This bar, it looks like this bar is huge, but this bar is generally already priced in to the pre-market because there's such a big correlation to the NASDAQ that even though this fund, like this index, doesn't trade, this is only how you track the performance of FNGU and FNGD. I bought about a little over half the position in the pre-market, and then I've been adding throughout the day little bits here and there, just so that as my short loses money, this makes me money at a much faster rate. And if the short keeps working against me, I will, at a certain point just bail out of it. But as this goes, I will take equity from the short and add equity to the hedge, making it so if I'm still losing money, my losses, the rate of loss is lowering and the rate of gain is rising. And then as we get a reversal, I switch those weightings around.
A balanced position, expecting it to go vertical. The same thing works to the downside, right? And then the reverse automatically, literally, right? If you could literally buy one and wait.
Wait a minute. I think I missed what he was saying.
Point. Always does. Okay, any vertical move is coming from a balanced position, generally speaking. And so the way to trade that would be, you could literally, if you sense the market balance and starting to break out, you say it's going to break to the upside, and you're expecting a vertical move, not a reversion, a dislocation of inventory. You could literally buy one and wait 30 seconds. And if it's not in your favor, you get out. But you could literally write a program that would say buy one, and then 30 seconds later buy another automatically, and then buy another 30 seconds later, and then buy another. And then as soon as the next 30-second entry level is below your most recent entry, you just get a box that shows up and says, would you like to exit the trade? This entry is no longer at a higher or low, in the direction that you're trading, and just hit exit. And that would be the way you could trade and exit. No, as far as I know, no one has written that program, or they are doing it in the high frequency shops. But that would be the way that you would trade the market from a vertical, a balanced position, expecting it to go vertical. The same thing works to the downside, right? And then the reversion is 180 degrees the opposite, right? So now, after you've had the vertical move, this is where the art of trading comes in. How far is too far, right? Does prudence dictates exiting a winning position long before the high?
It was that part that I was mentioning that I missed, which I think is really, another kind of key. And that's why I like pyramiding into and out of positions. Like, I almost never sell all of a position all at once, I might sell, depending on what the momentum's looking like and the reasoning for the move, I might sell just like a third, a half. I may only leave on a third or 25% or whatever for like hope of continuation. But as I'm getting to like certain profit targets and, extending, because the breakout by nature, you're extending away from the mean. As I'm getting extended from that mean, I'm taking profits in anticipation of the next time it starts to revert back to the mean.
Not every tree grows to the sky. Nobody, there is there happily ever. Not everybody has happily ever after, right? The idea is how far is too far with vertical, and you start to trade. The market's going to go through this cycle of vertical and then get balanced. Well, as the market's getting balanced, in other words, think about it this way: as you have spent more time going vertical, more and more people have gotten on board, which means that the idea is that more and more people will now have that same position, which will lead to retracements, which lead to the market getting balanced. So the best time to initiate with a reversion program is early in the cycle of the balancing site part of it, right? It's almost like, if the market's going up, it's like you're selling them hoping for somewhat of a reversion before anybody else, that first little dip or something like that. Anyway, the point is that you switch from the market leaving a balanced position, and we know that there is zero chance of a retracement because everybody's got a balanced position. Everybody's going to be trying to get on board. And everybody's, there's no chance of retracement when the market's going vertical from a balanced position. And then you flip completely to selling rallies and buying dips, as you said, as the market goes through the finishing phase of that cycle. In other words, if the price of something is so low, you can see this in equities, right? If the price of something is so low, so many people want to buy it, it moves away from there quickly, right?
Mm-hmm.
And if the price of something is too high, it moves away from there quickly, right? Leaving a tail, which means that the true opportunity at the low is a finger snap, and the true opportunity at the high is a finger snap. Which means that if you think something is the low and you buy it and it gives you a second chance, it's not the low, right? And if you sell something at the high and it comes back there, it's pretty good chance it's not the high, right? So in trading, you never want a second chance at something.
That's a good thought.
Right? I mean, think about it, right? In other words, you don't want a collective ambivalence about something, right? You want certainty, right? And you want to know, right? Like if I bought them, because in game theory, if you operate with the least amount of information and you're right, that is a really significant reference point. So if we're operating in a situation, if you're taking a stab on a trade where you think it's the high or low, and it's only up there for a second and you happen to be right, then you know that there's more to that trade than you thought about, because everybody else is waiting for confirmation and they're not going to get close to the price that you executed at.
You use the word program.
So yeah, that's all I wanted to show on that and discuss more or less. Shitty week, which of course is why I'm wearing the Not Stock shirt, because the P&L is down. I gave back too big of a portion of my profit from the last good trade, which is upsetting, but it is what it is. So I will, It's like a repeating, ongoing thing of act, record, adapt, repeat, just over and over and over again. Like journal. I use Trader Sync, and I also keep like a running journal on Google Docs. So I'll take my screenshots, I'll record everything, my reasonings, my failures, and adapt and repeat.